Hello everybody, welcome back. Today we're going to be talking about day trading versus investing. We're going to be covering the pros and cons of each to help you make an informed decision of how you want to invest your money. Because right now you go on YouTube and you see day traders peddling day trading and you see investors peddling investors. So we're going to look at the pros and cons of each to help you make an unbiased decision. So first things first, we do a big chart. And here we have the big day trading. And here we have investing. All right, the first difference that we have between day trading and investing is that with day trading, your instrument doesn't matter, and it does with investing. And if you don't know what an instrument is, basically, when you're looking at a chart, whatever like stock or currency or commodity you're trading, like if this is oil, then the instrument is oil. If this was like Coca-Cola stock, then that's the instrument, Coca-Cola stock. So the instrument is basically the thing that you're trading or investing in. So with day trading, no matter what the chart looks like, you can profit from it. So for example, let's say we have wheat here, and let's say here we have stock index. Oi, that's a bit wonky. So with day trading, you can profit off anything because you're able to buy and sell with the smaller fluctuations in the market. So on here, you can see bought there, sold there, profit. Bought there, sold there, profit. Bought there, sold there, profit, and so on and so on. It's the same with the stock index. Bought, sell, bought, sell, bought, sell, profit. Oil, bought, sell, bought, sell, bought, sell, profit. Whereas if you have a chart on investing, and let's say you pick the wrong stock and the stock's declining, so you've bought here, right? And the value of the company is going down, so you're losing money. You can't profit off of the downward swings because you own stock in the company, and stock doesn't go up when the company goes down. So basically, when you're day trading, you can pretty much profit off anything. There are some instruments that make it easier or harder, but the principle is the same. You can profit off anything because you can profit from long and short. And investing, you have to pick the right instrument, one that has fundamental reasons to grow. The second difference we can point out is that day trading doesn't pay dividends, and investing pays dividends. Not all the time, but it is a thing that happens that doesn't in day trading. So when you own a percentage of a company, like quarterly or like however often they do it, they might pay you a percentage of their earnings, which is dividends. Whereas with day trading, you don't actually own any of the stock. You're just trading on the underlying value. So even if you're day trading a stock, you're still not going to be paying dividends because you don't actually own a part of the company. You're just betting on which way you think it will go. So if we have a company here for investing that's doing really well and growing, and we'll say that this is a year. So if we say this is a company doing really well, this is 3 months, 6 months, 9 months, 12 months. Because it's doing well, on these months, you're going to be paid a percentage of their earnings because they're doing well. Whereas if the company is not doing well, the dividends you get paid are smaller because the company is losing value. So when companies are doing well, dividends are higher. When it's doing poorly, dividends are lower. Day trading, dividends are nowhere to be seen. Okay, so difference number 3. Day trading can have a smaller maximum drawdown, and investing probably has a larger maximum drawdown. And the difference is usually emphasized in a market crash. Let's just say this is the S&P 500 and it was doing well, and then some kind of global crisis happened and then the value plummeted. And if we say that the difference here is 60%, well, with day trading, because you're in and out every single day, once this happens, you can say, oh, market crash, I'm not touching that, and then your money is safe. Whereas with investing, because you've got money in the company, it's doing well, when the market crashes, you still own a bit of that company. So you're going to lose that 30, 40, 50, 60% or whatever it is. Like you can't escape that unless you sell your stock. So with investing, your maximum drawdown is probably going to be somewhere around the 50, 60, 70 at the very most percentage. Whereas with day trading, like if you're terrible at it, it could be 100% just because you suck. But if you know what you're doing, this 60% drawdown could be reduced to like 10% or 20%. So if you know what you're doing, day trading can have a lot of a smaller maximum drawdown when things go pear-shaped, whereas with investing, you're kind of locked into that big drawdown when the market crashes. Okay, the fourth difference we have between day trading and investing is that with day trading, you can profit off long and short moves, whereas with investing, you can only profit off long moves. And if you don't know what long and short are, long basically means buying and short means selling. So if you have a instrument that's going like this, for example, with day trading, you can buy here, sell here, and you've made money. But you can also sell again here, even though you don't own any, and that's called going short, and then buy back here. So you've made profit here and profit here, repeat, profit there, profit there, profit there. Whereas if you have the same chart with investing, when you're actually buying shares of the company, you obviously can't sell shares you don't have. So if the company is doing the exact same thing, and if we say this is a year-long period, your value of your stock, you profited there, lost it again, profited, lost it, profited, and then lost it. So over the whole year, you've ended up at square one, because for the whole year, the stock was sideways and you couldn't profit off of the market going both ways. However, when we broaden our horizons and look at a very long-term thing, this same chart, right? This same chart, let's say instead of 1 year now, we're looking at 10 years. We had our sideways period for a year, and then it started doing this over the course of the year, and obviously we got the same chart here. So the difference I'm illustrating is that day trading has a very low probability of success. After 5 years, the percentage of traders that fail is over 90%. Like, it's very unforgiving. So in your first year, you went sideways, and let's say, I know you made like 20%. Well, next year, even though the market went up, you sucked and you lost 50%. Okay, now you're losing. Let's say you made 10, you made another 10, and then the market was bad and you suck, so you lost 60. This is like 6 years here, and you're still losing as a day trader. Whereas in investing, you buy here and you wait, you don't even touch it, and boom, you win. That's the advantage that investing has, is that you pretty much know it's a very high probability that over a very long period of time, you're gonna win. If you just put money in and you don't touch it and you let stocks do their thing. Companies grow, right? Especially if you put money in a stock index, which is a collection of the best performing companies, it's literally almost guaranteed to grow. Now, even though day trading has the low probability of success, we are able to use leverage in day trading, and in most cases, you don't have leverage when you're investing. Leverage is basically a multiplier of your buying power. So if you have $1,000 and you have 10 to 1 leverage, that means you can now buy $10,000 worth of stocks or instruments or whatever. And if you had 100 to 1, then you would have $100,000. With investing and buying real stocks, you're pretty much limited to no leverage, 1 to 1. There are cases, you can take out loans and stuff like that, but in general, this is the difference. No leverage, leverage. And what that means is, if you're very skillful and you're one of this 10% that make it, so now let's say he's got a 50% win, 10% loss, 30% win, 20% loss. That's pretty big. That's 80% win, 5% loss, 20, 10, 30. So now this very skilled day trader, because he's using leverage, instead of making 5, 2, 8, 2, 3%, he's now making 50, 20, 80, 20, 30. He's multiplying his wins by 10, but because he's skilled, his 1% loss only becomes 10, 2 becomes 20, 0.5 becomes 5, and these are still very, very manageable losses. So he's used leverage to really, really, really maximize his returns without making his drawdowns so large that he can't handle them. Whereas obviously without leverage, yes, you're gonna make money here, but let's say this was a 30% gain. With leverage, obviously it could be 300%, but you just don't get that without leverage. But you do have to be careful with leverage, because if you're unskilled or uneducated and you go with too much leverage and too much position size, a tiny move in the market can wipe out your entire account. So you need to be careful. The other thing that means is that with day trading, when you're using leverage, your losses can exceed your investment. If we go back to here, right, and you bought here, you had 10-to-1 leverage and you used all your money, and it went down here, you're now in big negative numbers. You now owe your broker money because you didn't understand what you were doing. Whereas with a stock, if you owned 2 shares at $500, that means you spent $1,000. If the company goes to zero, you only lose $1,000 instead of $10,000 or $100,000 because you weren't playing with leverage like that. So leverage is like a double-edged sword. It rewards the skilled traders and punishes the bad. And on that note of rewarding good, punishing bad, with day trading, your skill is very important to your success. You have to know how to get good entries and exits if you want to make money as a trader. Whereas with investing, because of that pretty much guaranteed profit, very long term, it doesn't matter if you buy in here or here or here or here or here. In the long term, it's going up. Whereas with day trading, if you buy in here, you got to sell. Like, you lose. You buy in here, you lose. You buy in here, you lose. You buy here, you lose. It's very important to buy in these dips and sell during these highs. Because if you don't get that right, then your money is just going to obviously dwindle and say bye-bye. So when someone comes to me and they want to invest their money, but they don't want to do any research or effort, they just want to put their money somewhere that's going to make some money, I usually suggest something like an index fund, because it's pretty much guaranteed to work and the skill's not important. So it's usually good for someone that doesn't want to invest like a lot of time to learning how it works. But if someone wants to be extremely lucrative and they have what it takes to do the research and all that for day trading, then perhaps this is something for them. The next difference is that with day trading, you can have very quick, instant results. However, with investing, you have to wait that long time for the company to be successful if you want to see good gains. So let's zoom in now. We'll say that this right here is 1 week, and we got a thing that's going all over the place. If you're skilled in day trading, you can obviously buy here, sell here. That's like 1 day, 2, 3, 4, 5, 6. It's close enough. You can buy here, you made money in 1 day. Sell here, you just made more money in 2 days, more in 3, more in 4, more in 5, 6, 7, 8, 9. Whereas with investing, this is pretty much sideways. So in day trading, you could have profited instantly within the first week if you were skillful. However, with investing, because it's sideways, it basically didn't move and you made nothing, because you have to wait the long time for the company to grow if you want to see the results. So if you're starting with a very small amount of capital, like $100 or $1,000, it's almost going to be meaningless to put it in investing, especially if you don't add to it later on. Like if you start with $1,000 and you're adding $100 a week to investing, then it can have some kind of payoff in the long term. But if you put $1,000 here and you left it for 10 years, it's still only going to be worth like $2,000 or $2,500. And that's just not really worth your time at that point, right? Like 150% profit in 10 years, like $1,500, that's like pocket change over 10 years. Whereas obviously here, you put in that same $100, you could make 10, 15, 20, 20, and that's like $200 in your first week. So now you've already doubled your money, and then at that point it becomes 20, 30, 40. There's another 500, another 500, and then in a month you've now doubled your money because you were very skilled and you got those instantaneous results. And I just want to clarify, that example of doubling your money in a month is very, very, very unlikely and probably very risky. With day trading, a good result is more like 5, 10, 15% per month. Even 5% per month is extremely, extremely good. So don't let that example of doubling your money every month cloud your judgment, because that is not going to happen unless you're some kind of prodigy or very, very stupid. The next difference we have, with day trading, you have to check the market often to see what it's doing. If we go back to this example and the price is fluctuating during the day, you need to be there to buy in during these dips. If you're not there, then obviously you're not going to be there to buy, and you're just going to have the same results as this sideways investing thing, right? So if you're trading on like a 15-minute chart, you need to be there every 15 minutes to see what price is doing. And if you're not checking it, you're just not going to be successful. With investing, you don't need to check it. because you're like, it's all right, I've put my money in for the long term. I know that if I put money in and wait, it's going to be successful. So I can buy here and I don't need to check it. Maybe I check it every year and it's like, yep, every year I'm making money. That's cool. Very, very easy. So day trading obviously takes a much larger time and effort commitment than investing does. However, as we talked about before, with leverage and skill, and the profiting long and short, obviously the rewards of day trading can be much greater than investing if you're skillful. Analytics. With day trading, there are some very powerful platforms out there that give you a very deep insight and understanding into how you're trading. And they can tell you things like if you're profitable on a Monday versus a Wednesday, or in 3 p.m. versus 10 a.m. They go down to that kind of level. So you can, if you trade for a while and then you get this picture, it's like, okay, this is where I suck and this is where I'm good. Let's do more of what's good and less of what sucks so that I can multiply my results even more. So like if you're trading and then every week or every month you're looking at your analytics and then improving your performance, next month looking at your analytics, improving again, the results become like very exponential. Very exponential. Whereas with investing, you don't really have analytics. All you can pretty much do is, well, the company is going good. That's good. Keep going. Like, yeah, you might be able to pick better stocks, but at that point, you're becoming more of like an active investor rather than investing in a company because you believe in the company. At that point, you're a stock picker, you know? And then you are moving a little bit closer to the trading side of things. So with day trading, you get these powerful analytics that help your performance grow over time. Whereas with investing, you pretty much have to wait for the market to go up and you can't really do anything about it. Okay, second last one. And that is tax. With day trading, because you're buying closing. Every time you close, that profit becomes realized profit. And basically, we have realized and unrealized profit. Unrealized profit, let's say you buy here, the price goes up, but you didn't close. It's unrealized because you haven't actually sold and the money's not actually in your account. So when you're making lots of trades all the time, it becomes realized profit, therefore it's money you've made, therefore you have to pay tax on it. Whereas with investing, if you bought here and you didn't touch it this whole time, you technically still haven't sold and the money's still technically not in your account, so therefore it's not your money and therefore you don't have to pay tax on it. So that's the other thing you have to factor in when deciding day trading versus investing, right? You're going to have to factor in tax into your performance. So not only do you have to beat the market, you also have to factor in tax, and do you still beat the market? And obviously with investing, when you do cash out, you will have to pay tax on these gains, but you only have to pay tax once instead of here. And then our last one is that day trading is more fun, right? You can sit there, you can watch the market. It's very exciting when it's going up and down. You can make algorithms and you can improve the algorithms, and that has like an effect of, oh yes, I'm doing really well. I love improving myself. And you're actively trading, making decisions, making money, and you can see it in real time as you go. Whereas with investing, it's kind of like put my money in and wait. Like, okay, cool, I'm gonna go have a sandwich now, I guess. It's like, there's just not much to do here. But I do want to clarify, if you're doing day trading for fun, you're probably not going to be successful. You do need to treat it like a job, because if you don't treat it like a job, it's not going to pay you like a job. And if it's not your job, it's not paying you. So you do have to take it seriously, and you do have to think about risk management and indicators and strategies and position sizing and timing and blah, 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 right? Like the stuff matters, but that doesn't mean it can't be enjoyable. And obviously, once again, with investing, money in, nice. So that concludes my list of 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13 differences between day trading and investing. I hope my very cool charts and my very good explanations have helped you make a decision of whether you want to be a day trader or an investor. If you liked the video, smash like. If you hated it, smash dislike, although it doesn't matter anymore. Leave a comment on something you want to leave a comment about. Visit my website, theachievementapex.com. Follow me on Facebook, Instagram. No, that's it. Bye-bye.